Guys, great to see you all. I've seen a couple of you taking assiduous notes during the presentations, particularly Dr. Doug. So really looking forward to hearing all your insights. Eddie, I want to start with you. Not that I want to put you on the spot or anything, but you've been in the game for more than 30 years now.
Yeah.
Now, I haven't generally thought of day traders or more long-term traders as introspective people, but today I'm getting the sense that actually a bit of introspection can go a long way. So given that you've been doing this for such a long time, Eddie, what do you think it is about you that's meant you're still succeeding 3 decades on?
I think it's the hard work. It's being able to always realise that it's hard work, and being able to embrace that hard work and say, I enjoy this. I heard a long time ago that if you work really, really hard, you'll get rich and you might make a bit of money as well. And that's the way I feel about it. There is a richness in what I do and what I have done that has been its reward, and not necessarily always monetary, but it's a great, great industry and a great thing to be involved in.
What time do you get up in the morning?
About 3:15, 3:30.
I thought I was the only one.
No.
All right. I want to turn to you, Alex, just to get a bit of a flavour, because what's great about these three guys is they all approach futures trading from quite a different perspective. So, Eddie, you work a lot with the technicals, obviously, and we'll come on to that in a second. But, Alex, I want to hear more about how you and your firm traded the event risk of the Italian election.
Yeah, thank you. Yeah, so we're a proprietary trading team based out in London, and a little office in Poland, and a small little satellite in Cyprus. And our entire approach when we're trading the Italian election, and we're day traders, is we take highly leveraged positions. We're very involved in harvesting, volatility, and that's and how to cultivate that edge. Now, for us, the edge, just a great talk by Doug. But for me, a lot of the time, that 5%, it can be as little as 5% mental, because if you don't have that skill, if you don't have that edge, it doesn't matter how hard or diligently you've worked, you can't extract money from the profits if you aren't able to recognize those patterns. So with the Italian elections, we noticed a really large volatility climax starting to happening, days, a couple of weeks ago.
And Alex, sorry to jump in, but we actually have a chart that demonstrates, Can we get Alex's chart up, Kevin, exactly what you were doing? Sorry.
Yeah, so for us, in the firm, we don't actually train people to have views, because views don't make you money. And what we do train people is to really focus on patterns that we've cultivated as a firm, or of how we harvest. So over here in the Italian elections, what we're actually noticing is, if you can see just further on down around about 2 weeks ago, where you see the white line and you see the orange line start diverging, and you actually effectively get a heightened negative correlation. Now, we don't trade these opportunities, and we actually trade on what's called a DOM, a price ladder. And we look for these, and that's for our timing. And so when the Italian elections, when the BTPs, which are the Italian 10-year bonds, and the 2-year bond, the BTS, was starting to create the systemic event throughout the asset classes, was how we're going to get involved in the bond market, because the liquidity in the market of the BTPs completely disappeared overnight. So from our perspective is, what type of order flow? So they mentioned earlier on, and CME mentioned that the technology is becoming more readily available for the retail trader. And in the past, you needed to have large technical infrastructure, and now you can actually trade on what's called the order book. And it's actually seeing the participants in the market exchanging. It's equivalent to watching the old days, the pit, where the people are auctioning, and they're in the open outcry pit, and that's what you can actually see on what's called the price ladder. So on that day, when their liquidity completely disappeared, it was a Monday, Tuesday, Wednesday. The BTSs in the futures market, was literally on the order book. There were 1 to 2 lots, as opposed to on average 200 to 300 lots. So how do you hedge that, and or how do you speculate it from a profit perspective? And what we are doing is participating mainly in the German bond market, because there's still liquidity there as they were hedging in that space. But it's all well having that view. Is how do you observe the patterns to extract the opportunity? And what we do is, on that day when the BTPs made their absolute low, the the current low, you always get, and we had it on the Brexit, we had it on the Trump, and it's just a little order flow event that we look at as a firm, where you get the final crescendo of the volatility of the move, and you'd get these large, abnormally large orders, 3,000, 4,000 lot. Some of you might not mean that much, but this is 6 to 10 times the normal size. And whenever we see that, we know that there's a potential reversal in play. And so we started getting long on the BTPs and BTS because of that order flow event. So that just describes it in a long-winded way.
Yeah, and you can kind of see how you can benefit when there's high volatility. But until the big market sell-off we saw in February, actually volatility was suppressed for quite a while. Is that a problem? And if it is, how do you work around that, Will?
Well, I mean, not trading, as I think Dr. Doug said, is one of the hardest things to learn. When there's a lack of volatility, it really is about being incredibly selective and disciplined. Because one of the problems in the low volatility market is if you do end up trading just because you're bored or just because you're in front of the screens, it feels like an eternity before another opportunity comes. One of the things I wanted to talk about to you guys about trading futures specifically was the idea that we have a room here of traders who are moving away from the retail space into much more professional remit, whereby they have access to futures, to derivatives, they've got the live news feeds, they have a multi-screen setup, which also means they have many, many, many reasons to always trade. In the CME in your bags, you've got a tool book, which lots of really cool, sexy things to do. You can apply them all to your charts and find any type of reason to trade. And I think one of the biggest challenges then, if you guys are going to move on to futures, there's huge advantages as we've discussed, but one of the biggest challenges is the behavioral elements then when you're accessing futures, the price ladders, all of the movements and the volatility is it becomes much more accentuated. I just have a chart here to try and almost show what not to do. This is an example of a trader moving to futures for the first time, getting their playbook right, just as Dr. Doug was mentioned on the left-hand side of the screen, top left, you can see they're trading the euro versus the dollar, the blue arrow buying, red arrow selling. They're following a strategy of just trading the range, nothing too complicated, nothing too exciting. And then they keep their discipline until 1:30 when non-farm payrolls comes out. This is the euro versus the dollar. So everything's so far going according to the plan. What's quite disconcerting is that we see this sort of behavior in new traders that move to futures, but also, I fully believe that if you're doing this for a living, you deserve everything that you ever make because of the sheer behavioral effort it takes to remain disciplined. Because what you can see here is non-farm payrolls comes out, the dollar strengthens, so the euro moves lower. The trader goes short, gets stopped out, feels frustrated, so waits all of about 5 minutes before going short again, getting stopped out. And then, I don't know if you've read the book, I think it's Steve Davies, the Chimp Paradox, or Steve Peters, sorry, the Chimp Paradox, whereby this guy clearly after 2 trades inside his head moves to a cage, opens the cage door, grabs his 200-pound gorilla, sits the gorilla down, gives the gorilla the mouse, and lets loose. And you can see that just by a complete erratic trading. So when there's no volatility, one of the problems is the feeling that there won't be an opportunity. And it's that feeling you're looking at the screens and you just don't know where the next opportunity is coming from. Equally, when there is volatility, as shown in this example, it's all very well knowing what you should do, as Dr. Doug was saying, a strategy, a playbook, discipline. It's just, I believe that when you move to futures, you probably do need to get burnt a few times and go through that process to learn the hard way about discipline, not to act in this way.
Yeah, and Eddie, on that point, how much should you focus on the past in terms of learning from it for your next trade? Or how do you balance that with actually letting go of the past and just focusing on what's in front of you?
I think with all forms, and this is talking from the technical analysis, you look at historically what's happened in the past and try to apply those lessons in the future.
Right.
Not all markets are the same, but there are plenty of things that you can actually use and say, this will apply in the future. There's a likelihood this will happen. It will probably move in this direction, or this sort of action will happen. If you just concentrate on the single thing that you're actually at this particular point in time, then you're going to go nowhere, I don't think, really.
Alex, would you agree with that?
Yeah, I mean, the entire pattern landscape and how to determine of where you're extracting opportunity is a function. You mentioned earlier on of the hard work, but it's a large function of how you go in your questioning framework and your methodology of what opportunity is. And what I see in the retail market, what I see in the space with regards to the news that we get bombarded with, is the ability to pick up skill sets to extract that edge. And when you pick up that skill set, you find that people actually have that strong positive mental ability because they know the probability of success is high. Whereas I have traders on the floor, young traders who work incredibly hard, who do a lot of effort and a lot of work and draw these great big playbooks, but amongst all of that, they don't have that little edge that can really extract. You give a trader a little edge, he has that positive aspect. So the hardest thing is actually developing the skill set or the questioning methodology to find those edges in the market and those patterns that are repeatable but yet dynamic, because the market does change and shift, but whilst remaining the same.
Mm-hmm. Will, the word edge has come up a lot through this entire evening. What do you think gives a good trader an edge?
2 words for me, it's self-awareness. It's understanding what is being purely honest with yourself as to why you've made that decision, why you've entered into that trade, or why you want to be in a trade. And I think one of the things about technical analysis, for example, it's excellent in terms of finding an edge in many ways, but in other ways, we see people, when they first move to futures markets, using technical analysis to justify their bias very often and just tweaking levels and tweaking lines. And that can come from a lack of self-awareness in terms of really understand. I think that the edge is really having gone to the darkest, deepest places in terms of feeling lost and lonely and without any type of control, and then recovering from that so you can recognize it again. And I think that's quite important. I can never tell a good trader when they haven't had a bad day. I can't tell a good trader if they've only traded well, because I really need to see how they recover, how they're resilient when they go through a period of time when everything they do doesn't quite seem to work. How they recover from that, to me, is the core of what makes a successful trader.
Okay. Since we mentioned technical analysis, Eddie, why don't you talk us through your chart and what you find compelling about it or what we can learn from it?
Well, one of the things when we first spoke was I was going to bring the S&P futures because I thought probably everybody here would know that. But I thought everybody else would mention it as well. So I thought, would you like something esoteric? And I went, yeah, okay. So we'll do Kansas City wheat. This is on the CME, and this is a beautiful chart. This is beautiful. This is elegant. We've spoken about it as well. This is an elegant, beautiful chart. It has a number of features in it which are specific to what's happened over the last few months. Most of you are familiar with moving averages. And you can see that that's actually been underlying moving the market higher. But they're all lagging indicators. They're things that are behind the market. They're not contemporary at this particular point in time. Much as well as Fibonacci levels, which are, everybody knows where they are. That particular trident you can see there is actually a pitchfork. It's called in reality, it's a modified shift pitchfork. Now, I'm not going to go into the history behind it, but that's available on your Bloomberg. The Andrews pitchfork and a modified shift pitchfork can be drawn on it as well. And that gives you the angle of attack of the market, and it has done all this while. The middle time, the line through the center of it, has actually been so accurate at pointing it which way it's going. So I can see which way it's going until it stops going. I can see where the top end of it is. There's resistance when it goes too far away from it. There's going to be pressure to push it down. And I can see when it's going to go too low, well, there's going to be buying pressure coming in. And I'll use other things on it, candlestick theory and various other things. And again, talking about behavior analysis, one of the things, and something we spoke about as well, was the very first modern book on economics, probably, I think most of you would say, is Adam Smith's Wealth of Nations, 1775. In Japan, in 1750, Maneshi Homa compiled 3 books, and he compiled them. They were already knowledge that was already in the market. And that's what we use for candlestick theory now. In one of those rules that he had was, if you lose money, step away from the market for 30 days. Now, can I see any of you walking away from the market for 30 days? I don't think so. So we have to adapt it to modern times. Finesse and optimization, I see what you mean about on people optimize things. They want to read what they want to see in it. They're not looking at what actually is the picture there and saying, that's what's actually happening. Then, as Dr. Doug said, then I'll make my decisions. This is just part of what you need to do.
I want to talk about sort of looking at the future direction of the markets and making predictions, whether it's based on history or whether it's based on what's in front of you. It's not that I want to call you up on this, Alex, but we were talking outside just before we came in, and you were saying that on Monday, when the BTP futures opened, actually some of your traders were kind of caught by surprise by what the market was actually doing, because they hadn't expected them to react in the way that they had to the Italian finance minister's comments over the weekend saying that actually leaving the euro wasn't under discussion. And even I'm approaching this as a financial journalist, when the cash market opened at 7 a.m. and I saw the 10-year yield on the BTP drop more than 20 basis points, I was like, what's going on? So actually, can you always, well, obviously you can't because people get caught short sometimes, but how do you distinguish between those moments where you can actually predict and those where you can't?
Yeah, I mean, the game or the art of speculation is having that, artillery or the ammunition of strategies to deploy into the market, like any great, war general. And, for example, what happened to a broad-based, our London team on Monday morning was a result. I mean, you get the news firing in, and we knew before, the hindsight analysis, we knew already on the weekend that, there was not strong Italian news of them leaving the euro. But there was all the calls, and we have various plays that we play on the open. When the futures markets open at 7 a.m. UK time, we put on these relative R plays across the various government bond curves in Europe. And they're all, there are a few that are out of line, but one of the things that the traders never considered was the liquidity risk. It just required one trader on the planet that maybe needed 500 lots, and he needed to offload them on Monday morning in the BTPs. And so participating in a market, it's a lesson I learned when I dropped my entire account about 7-8 years ago on the chats on an ECB when there was no liquidity, and that was one of my first little affirmations and mantra. Don't participate in a market when there's no liquidity on the order book. So Monday morning came, and one of our traders who's had a phenomenal run, had his confidence, just edging forward, and the news came, and we knew about the news, and the news obviously gained more weighting in the media after the movement. And that's what always, traders get really irritated with the news afterwards. They always say, yes, so that wasn't important 5 minutes ago, but now it's important because they've had the justified move. And so we lost, we lost a bunch of money, but the learning from that is don't participate. The bonds you could have still participated, but why trading? Why trade a market or expose yourself when the liquidity risk is heavy? And we've all repeated that mistake, but it's the learning you take from that. The next time you're faced with that same scenario, how you engineer yourself or how you navigate yourself around that opportunity. And the nature, the greatest traders are the ones to take the learning and then push forward when they recognize that pattern and event again. They've consciously recorded it into their unconscious state, and they're able to extract and take advantage for the next time.
And I guess Doug was talking about journaling earlier, and I know, Will, that you're a big proponent as well of kind of keeping track immediately after events have occurred of why traders did what they did.
Well, just interesting listening to Alex when you mentioned about the liquidity in the chats. For me, I had the same. I think it was in 2008 when oil popped $30 at about 8:30 p.m. to 9 p.m. It was the biggest ever intraday move. And I got hurt on that move. And what was interesting is that as you get more experience, if you are able, these sort of experiences don't leave you. You can probably remember minute by minute what happened on that Schatz trade. I can remember on the oil trade. And what happens as you get more experience is then you recognize it as another one of those. This again, I've seen this happen, this is what I did last time, and this is what I won't do this time. And in that case, I think those sort of experiences, so learning a liquidity lesson, if you can survive them, they are worth the money that you lose. But interestingly, some of your research showed, Bloomberg's research showed a couple of months ago, that
you guys are all bigging up Bloomberg like crazy.
This is true. You know, over 50% of asset managers have less than 9 years experience. Now, why that scares me so much for the industry is because it's 9 years since we've had a major market correction. If you've been working in derivatives and trading for the last 9 years and all you've ever seen is relatively low volatility comparative to 2007, 2008, if all you've ever seen is when equity markets move lower, central banks come in and hold the baby and actually everything's fine. It doesn't matter about Greece, Italy, Korea. It doesn't matter about a proxy war in Syria because actually markets are consistently stable, which is really what we're seeing apart from a wobble in the beginning of February. Then my concern is that if we do get one of these big corrections, there aren't enough experienced people that can recognize it as this is another one of those. And they're going to have to learn that lesson for the first time, which is what is rather worrying in my opinion.
And is this all compounded, Eddie, specifically when it comes to futures and other derivatives, perhaps because of leverage?
I don't think necessarily leverage. I think what it's actually, there's a number of factors that have caused this. I think the electronic markets have helped in that particular sense. We were talking about situations, I mean, I just went through the whole list of ones I could immediately remember, which was first off the Euro Swiss. I don't know if any of you were involved in any of that one. When that sort of, that was a market not fit for purpose. There was actually no trading. There was no bids and offers in Euro Swiss at one point. Then you've got
January the 15th, 2015.
Yeah,
I remember it very well.
You've got the ERM crisis. I remember the Irish punt, which it was then. Overnight interest, and it was nothing to do with Ireland. Overnight interest rates were at 17,000%. You know, what? It's crazy. But those sort of things, the black swans or grey swans, more of those will happen, and the more will happen because we've got bigger markets, more participants, and it will come from somewhere. It may be Turkey this time. It may be coming from Argentina. It may be coming from anywhere else, and it will all come in somehow and affect us. It could be. There's some analysis that says the next crash will be in 2020 because of the 12, 13-year cycle that goes through. And it's actually 12 and a half, so it goes 12, 13, 12. So mid to late 2020 is the next crash is going to be happening. But whether it actually happens or not, there are signs beforehand. Before the Euro Swiss, I noticed some of the retail brokers started raising their rates. And you didn't understand why. It's because they weren't comfortable with what was going on. No line in the sand is ever a line in the sand. If the one thing you need to know is central banks can't stop markets.
And just because you've got all this perspective and you've pointed to some sort of incidents in history as well, I mean, I ask this a lot on TV and radio to, you know, CIOs and to the sell side as well in terms of whether it's more difficult to get returns in this environment. Is it from a trading perspective?
I think it is because you're getting less liquidity, less participants, the markets dry up. 2008 was an example where we had people not wishing to trade with each other, not wishing to, I mean, exchanges were fine, but the people were not wishing to trade with each other. And this is the OTC market, and that reflects, because a lot of liquidity in the futures market comes from the OTC market. So we didn't have that. So yes, it stops people trading. It stops the lifeblood of it moving forward.
Alex, how important is it to have a real in-depth awareness of macro events as well as being able to look at technical charts and being able to read the order book and that sort of thing?
Sorry, just to answer, I mean, just to go on the point that you just touched, we actually had as a proprietary intraday trading, we actually had our greatest years in the financial crisis. We've now the traders at the moment having the best times of their career. It depends what edges you can extract in the market. So I suppose it depends where your so-called institutional funds and your larger funds who find it harder to navigate that type of liquidity around. They find it difficult to extract returns, but there are day traders who are still making exceptional amounts of money, and discretionary day traders, the ones who don't require an HFT system or algorithmic, guys who are able to extract money. Your question was yes, the macro.
How important is not just an awareness, but actually an in-depth knowledge of macro events to add to being able to do technical analysis, look at the order book, and sort of other approaches to trading as well?
Yeah. So one of our core skills where we trade a lot, we trade all the central bank decisions out of the main. You know, the ECB, the Bank of England, the Bank of Japan, even the Bank of Canada, and sometimes the RBA and the Fed. So it's Fed and ECB, and these are
a big week this week.
Yeah. So these are our biggest days of the year, and a lot of retail traders look at it and say, well, you stay out of that. But for us, once you start building the narrative, and understanding the narrative against the contextual background of the technical landscape, and then overlaying that with your order book, which is really showing you the auctioning nature of the market, is where we start designing our strategy. And a lot of times you'll have on an event or on a day, you'll have the ECB that actually raises the rates, but the market wasn't technically ready to move in that direction because someone's been absorbing. You've been watching this person absorbing on the ladder between 28s and 35s for the last 3 days. That's information, order flow information that you can use on your overarching macro narrative that you've built up. So for us, the macro environment with regards to geopolitical events and central banks, there are patterns on how the news is released, how the market digests the news, and once the market has digested the news, how you could have even bigger news hitting the market, but the market digests less because the market becomes tired of the news. So it's understanding that entire timeline of events and when the opportunity starts coming to the market and when it starts dying out. And the best traders who are trading macro events using their technical approach as well are the ones who are able to isolate the ability when the sensitivity of the news to the market starts becoming dry, or when it starts really pushing up. So yeah, it's one of the most advantageous and one of the most opportunistic events for us as intraday day traders using the DOM, which is direct market access to the CME and the various products.
You're nodding along, Will.
Yeah, absolutely. I mean, I think at Amplify we definitely look at fundamentals as core, but there's a twist, I think. I know, I'm very sorry.
It's using the F word.
But you're going to like
using the F word.
You're going to like my twist. My twist is we try and get our traders to take one step back and say, right, this is what the fundamentals mean. This is what they should mean. But have that to one side. You now need to know what other people believe about these fundamentals. So use Greece as an example. In 2015, all of our traders had to learn about Samplas, the Syriza party, the intricacies of Greek politics mattered because that moved markets. Now you could have quite a major event in Greece, fundamentally, but actually the market doesn't care. The market doesn't care because it doesn't care. Behaviorally, it's not looking at it. So there's two levels to this. Number one is definitely understand the fundamentals, put the effort in, put the hours in, and get a deep, hands-deep understanding. But on top of that, try and understand what the market actually cares about, because that might be very different to what the fundamentals should mean. So yeah, fundamentals very important, but we do find sometimes our traders have the biggest losses when they understand the fundamentals and then they're sure that they're right. So they've applied a strategy without actually trying to see, well, you might think that's important, but that was important in another time. This is a different type of market now. So yeah, fundamentals are important, but behavioral and technicals as well.
Sorry, Eddie, you keep shaking your head. Should we just F the fundamentals?
I can live with fundamentalists, but they can't seem to live with me. I try to understand their point of view. I try to live with them. I let them carry on with it. But yet they don't like when I turn around and say, no, it's doing that because of the technicals. Today, when I was leaving, somebody from my grains there said, oh, that market's gone up back above your line because there was a USDA report came out today. United States Department of Agriculture report came out, and it helped. And I was like, and what? What does that mean to me? Nothing. I don't care. I really don't care. The chart tells you where it is. Everything is in the price. We trade the price. We don't trade what the USDA does. Then you trade a USDA stock or something like that. You're trading the chart. You're trading what's there. the product that was there. If you're not trading that, then trade something else. But it's the actual price you're interested in. And everything starts with the price, then you look at open interest and volume perhaps, and then you apply the knowledge you've developed in technical analysis. And the problem, I agree with you on this, matches are a dangerous thing for children. Technical analysis in the hands of people sometimes is a tool which is like matches for children, or kids playing in traffic, or putting a blender on top of it and plugged in and leaving the room. You've got to learn. You've got to go through the societies that are appropriate, get qualifications, and learn about that sort of stuff, and then apply that.
But it doesn't have to be one or the other. I absolutely disagree. It doesn't have to be one or the other. In fact, I think it definitely shouldn't be just fundamentals, and it definitely shouldn't be just technical analysis.
I mean, can I just have one? I'm actually, most of our trading is technical, and but the ability of a successful trader is how to leverage in the right moment. So sometimes we will go into the ECB and we actually feel that the market or the euro wants to go up, and the ECB's come out dovish. And technically on that price chart, it's coming off in the knee jerk, but you can see there's someone sitting on the buy side. Yeah. And because of that, and you have this technical conviction on the upside, you have the fundamental that's showing the opposite to the technicals, and you use that, you leverage that fundamental to get aggressively long on the long side of the euro. So you're using that information to lean on your technical pattern, and then you're extracting opportunities. So sometimes using the fundamentals provides a lot of ammunition, a lot of fire to your leverage position to get that long that euro USD, because someone was actually sitting there on the buy side.
I tend to think of it more like the fog of war that you get rather than fire. It just sort of obscures the view. You can look at it, and I mean, I'm not saying get it right. I wouldn't be sitting here if I got it right all the time. I'd be out there on a beach somewhere. But what I'm saying is that this gives you an idea. It gives you the edge, which you're all looking for. All of them. All of us are looking for.
We've talked a lot about the benefits of futures, but Will, what are some of the risks that someone who perhaps doesn't trade futures very much or is thinking of adding them to their portfolio, what are some of the risks to be aware of so that you can make the most of those?
I mean, I think the biggest risk really is, as mentioned before, it sounds like a benefit, which it is. Obviously, they're cheap and easy to access, direct market access, no spreads. You've got all of the bells and whistles. And I think in a novice's hands, therefore, you can do yourself a huge amount of damage. And normally when people add futures to their portfolio, I think it's when they can really discover the addictiveness of doing this in this way. And it's when people are trying to do it for a living, to take it up to the next level, then they can fall into those behavioral traps that we've mentioned. Just because it's there, the ladders, the market depth, you can see all of these things that are trying to encourage you to please your vices. And I think the biggest risk with that then comes leverage and margin. Somebody puts margin in their account, what's the maximum size I can trade? And let's go for it. And I think that sort of attitude can do someone a lot of damage very fast. So, the best thing about them for me is just the flexibility, the ability to be fast and flexible and skillful, where you can size your risk accordingly, size out of trades as you get the opportunity to do so, the speed of access. But I think with that comes great responsibility. And it's all about trying to be involved in the futures markets for long enough to go through those bumps, to get hit a few times, so that in 2-3 years' time, when you're trading with much larger size, because the best thing about it is what you do with 300 contracts isn't actually that different to what you do with 30 contracts, liquidity permitting. In terms of behavior, psychology, strategy, the reason behind the trade. So leverage can be exponential in terms of returns, which is great. But then obviously with that comes a huge amount of danger if you're not ready for that size. So you don't have to trade your maximum size and your maximum leverage. And I don't think 30 days rest is too much of bad advice, actually. I wish some of our guys would do that sometimes.
I agree with entirely what you're saying. And I think it comes down to what we saw earlier on. Do you make a choice? Are you here for the hormonal buzz you're going to get from trading, or are you here to make money? And that's the first question you should ask yourself. When you wake up in the morning, and is that what I'm going to do? If it's the hormonal buzz, leave the screen, go away, do something else. If you're there to actually start trading, then do it properly.
Is the risk return the same across asset classes? And how should you approach the various asset classes? Should you just go with what your background is and then hedge using futures? Or how would you approach it from that perspective, Eddie?
I mean, some futures are different in their cash settled and some are deliverable. So you have to bear that in mind. But I would, for me as a chartist, I look at them all the same. Right. They may be that I actually look at something specifically and say, this doesn't apply. I can't use an Andrews pitchfork on this or a shift pitchfork. I can't use Fibonacci on this because it's not really going. I looked at a cobalt contract on one of the other exchanges and it went through the roof. So I was like, kept pushing further resistance levels are higher. You can't always use things on those. So you have to look and say, this applies for this, but not across all markets. But the rules for actually your money management, I'm sure they apply across all of them. It's not unreasonable to say that most people look for a return of 2 or 3 to 1, the risk-reward ratio. I think that's the very old way of looking at it. So that's a very early starting point and moving on from there.
Alex, for you, is it mostly about the liquidity?
Answers exactly the same. Liquidity is a very important consideration. And then how we apply, so we use the market profile, which I think is a CME charting tool, and which shows the time structure of the market. And the market profile for us, which shows us the contextual arrangement of the market, has just a different approach across different asset classes. And so how you apply that across the asset class is up to you. Now, just with regards to technical analysis, the main thing is sometimes from our perspective, the best traders on our floor have the cleanest charts. You know, they don't accessorize it with 100 different indicators and moving averages because the markets, as Doug mentioned, are rather simple. Simple from the perspective of going up, down, or sideways. Hard to find your edge or the pattern that's consistent. And so from that perspective, a very clean landscape, and then having the ability to understand yourself individually as a person. And every good trader should actually have his own patterns that he's never read in any book. Effectively, all the best patterns are the ones that you've manufactured with all the subtleties that you're able to extract from the market. So that's really important. It's what we train all of our younger graduates is the ability to believe in yourself in uncovering the patterns of the market and how you perceive things, because we're all quite unique and different in how we perceive opportunity.
Wow. Will?
I think just 2 things that I'd advise anyone here looking to get into futures when it comes to asset classes. The first one is I don't think they're all the same in terms of how they move and how they're structured. We've seen people who work really hard to grind money away in Schatzbubble-Bund, and then they touch the DAX for a day and give away weeks of work. You've got to really understand the volatility and the personality of how these different assets move on the exchanges. And the second one I would say is try and not just stick to 1 or 2 faithfuls. I think what we also see when it comes to asset classes is somebody might always try and trade, maybe it's Euro-dollar futures, for example. And particularly then when they have a difficult time in that asset class, strangely enough, the one that they're struggling in, they trade more. Because then it becomes a personal vendetta. It becomes like a tie between you and that ladder that's got the negative P&L at the front. So when it comes to asset classes, if you feel like you're out of sync with one, you're not reading it correctly, just move on, look at something else. So I think they are different, and don't be stubborn in sticking to just the ones you know.
We literally have 60 seconds left, so not to put you guys on the spot, but just a final word, a piece of advice for everyone in the room and everyone listening on the live stream. Eddie.
Join your local Society of Technical Analysts.
Alex.
I think that was quick enough.
So do I have 90 seconds now?
Do whatever you want.
I think the most important is trusting yourself and having an ability, a questioning framework to ask yourself at the end of each trading session of what you saw in the markets. And for us, what we do a lot is we ask the question, is where did the moves originate from? What did the context look like? And then slowly, the brain is incredible. You start putting the puzzles together. And over time, through that conscious, deliberate practice, you pick up the patterns of the market.
Yep, and for me, it's just self-awareness. Be honest with what you're feeling, and if you can recognize when the gorilla's going to sit at your computer, then just take a break, 30 days or less.
Fantastic. Thank you so much. Eddie Tofpik, Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International. Alex Haywood, Co-founder and Head of Strategy at Axia Futures. And Will DeLucy, Managing Director at Amplify Trading. And I think you're all sticking around. So if any of you, try not to swamp them, but if any of you want to talk to the guys afterwards, I'm sure they'll be more than happy to take your questions. Thank you so much.